Good afternoon. This is going to be the recorded lecture, which is in lieu of the Zoom meeting, which was scheduled for Wednesday, the 29th of July. And unfortunately, due to problems with Zoom and problems with recording, that had to be abandoned. So what I'm going to do now, hopefully in double quick time, because I don't want to take up too much of everyone's time, is go over what you need to take away and hopefully to inform the treatment of Chapter 5. Chapter 5 is what we're doing today in class. And so without further ado, I'm going to move now to looking at the PowerPoints for the week. Okay. We're looking at Chapter 5, Risk and Return. And similar to previous weeks, and in fact the plan for the rest of the term, I'm going to be going through those parts of the PowerPoints which I think you should take seriously, and directions as to how to deal with the rest of the PowerPoints for this week. And the PowerPoints are intended really to be a summary and to a certain extent an application of the chapter. So read the chapter, look at the PowerPoints for an overall kind of view. You can either do that before or after, and this lecture hopefully will kind of give you an overall survey of that, and plus a couple of other hopefully useful ideas and perspectives. And so that's my plan. We're looking at risk and return today. Risk and return. The important thing about the finance world is that it has to do with buying the future. That's a good way of understanding what an investment is. I might think I'm buying a share in BHP or the Harbour Bridge or whatever it is that I'm going to be buying. But in fact, I'm interested primarily in that set of cash flows, which is going to come from buying BHP shares or a block of property or whatever it is. And the reason I'm going to buy those things, equities, shares in companies, or property, or perhaps a debt investment, a debenture or a government bond, is because I expect in the future I'm going to make more money coming into my pocket as a result of owning that thing than goes out of it in terms of the initial cost and the other costs that sort of come in. Last week we looked at discounted cash flows as the mathematical tool that we use to analyze the balance between the present and the future, and hopefully make sure that I only buy things I'm going to make a whole lot of money out of, and the more money I make out of it, the more attractive it is to me. So that's, if you like, the whole finance game. This week we change horses. We recognize for the first time in this unit that we do not know the future. So far, if you go back over the last couple of weeks, you'll see that we've been really assuming that we know that if I buy a investment today or I put my money in the bank today, that I'm definitely going to be getting these nice dividend checks year by year, month by month, whatever it's going to be, or interest payments or whatever it is, going to have some sort of cash flow benefit. And in the end, I'm probably going to sell it, and then I'll make all this money, and hopefully the present value of those future returns, those future cash flows, is going to be really attractive, and I test that against my discount rate, my expected rate of return. That's really a summary of what we did last week. But it's also, I know those things with certainty. The truth is, I don't. And so today we're going to lock horns with the reality of not knowing the future, because for the first time we're going to include the concept of risk into the concept of return and those future cash flows that are going to come pouring into my pockets. Okay. In the PowerPoints, we go through a quick review, idea of return and so on. You can go do that. That should be fairly straightforward. Okay, we've got return, not a problem. Overall, we can work out the total benefit from owning an investment, and this formula is worth a little bit of attention, a little bit of practice, and a little bit of thinking about. This is a mighty important formula. We call it here the holding period return, there are other names that other textbooks and other parts of the investment world use for this formula. But basically what it's saying is that the total benefit from owning an investment, owning a capital asset, is the combination of the cash flows that come from it, the rents if it's real estate, the interest payments if it's debt, the dividend payments if it's an equity, some form of regular payment. We call those the cash flows. And also the capital gain. So if I buy an industrial unit or a block of office, like an office block in the city, I expect that the office block, when I sell it, is going to get me more dollars back than I spend on it to buy it. That's just the way that real estate works. It tends in the long term to become more valuable. So capital gain is important. So the top line of this equation is made up of two components. The price to sell, which is P1, minus the price to buy, which is P0, the value today. So that's the capital gain part. And then we've got the cash flow part, which, depending on what the investment is, will be either rental on real estate, interest on debt, or dividends or profit shares or whatever on an equity, a share in a company. That formula is worth remembering. Write it on the back of your hand or sort of write on the back of your eyelids or something. It's not a hard equation, and it's one that you really should know about and think about. And it makes common sense, doesn't it? Here we have the same thing with a worked example, and there are a couple of slides here sort of doing that. I would like you to actually do this yourself. Do it with your financial calculator, set up a little tiny spreadsheet for it if you like, but one way or another, do the maths. Okay, we've got $45 of capital asset value turning into 55, and there was a $1.25 dividend. What's the total return? How much wealthier is Jack now as opposed to a year ago before he bought the asset, the capital asset? And there's the maths, not hard. We can look at another example, and we can see it gets a little bit more complicated when we've got more time involved. Really, we should be discounting the cash flows. We're not worrying about that right now. However, it just gets the idea of what's going on. Okay, hang on. Let me not get too far ahead here. I want to just go down one more slide. Spend time and work out that math so that it's really obvious to you and easy. What it's saying is what I've just explained. The increase in wealth of Jack or Jill or whoever it is who's owning the asset, made up of two parts: capital appreciation, or in real estate we call it capital growth, and the income, the regular income from owning the asset, which is often referred to in a lot of the text, and I think it's a very good expression. It is the operating income, the income from operations. And so we've got the capital gain and we've got the operations. They're the two sources of benefit from owning an investment. In some cases, for instance, if I buy myself a business, the business might consist of, let's say, a machine. I might buy myself a jumbo jet, or these days an A380 or something, and with the intention of flying people around the world and making money out of the plane fares. At the end of, let's say, 10 years or 20 years or however long an A380 holds together, I probably wouldn't get much more than scrap metal value from it. And so the capital appreciation, while I assume that's going to be happening with real estate and to a certain extent equities in businesses, like shares in businesses, for a lot of capital assets, especially physical assets like A380s, like commercial airplanes, or computers or motor cars or other machines, the capital appreciation is actually negative because there's depreciation because machines wear out. And so this capital appreciation component, depending on what the project is, can often be negative, in which case you're aiming to get most of your money out of the cash flow. But using the simple approach, you're able to get a pretty good handle on the way that investment actually increases your wealth. Okay, we're talking about return. Now, I want to get us to this point here where we start to think about the way that we don't know the future. It is risky. Now, this is fairly fancy. I would like you, in your own time, to just check the maths here. I'm going to put together a nice little spreadsheet, and I'm going to do that so I demonstrate this particular example. I'd like you to do this either with a calculator or with an Excel spreadsheet yourself. Okay, what I'm going to do, I'm going to sort of come my little spreadsheet over here. I'm going to look at what's happening here. This is the situation where you're not sure what the cash flows in the future are going to be because the future is risky. And so I might say, I think that the situation could be returning a particular return. However, the actuality of the results is going to be influenced by what actually happens. And so, for instance, I might think that the economy is going to go ahead in the way that it's going at present. And so I say there's probably about, let's say 3/4, let's say 70% chance that the economy is going to continue the way that it is at present. But there is a little tiny chance that there'll be a recession. We'll say that's 10%, and a 20% chance that the economy won't go into recession. It'll actually go gangbusters and boom. Now, right now, looking at COVID and all the rest of it, I would say there's probably about a 70 or 80% chance that the economy is going to go into recession in the next year or two, maybe even in the next couple of months. There might be, what do we say, let's say 70 or 80%, just sort of ballpark guesstimate. I'd say there's probably, 20, 25% chance that the economy might stay kind of moderately tolerant if we pull our heads in and get the economy working again. And there's a microscopic chance, maybe a 1 or 2% chance that the economy is going to boom as a result of COVID. Maybe the Australian economy will reshape itself sort of on the industry of making face masks or something, in which case we might have a boom in the demand for face masks, However, what I've done, I've just looked in my crystal ball and said, what's the economy going to be like in the future? And I've put some percentages on it. Now, keep in mind, put your antennas up. Where do I get these percentages from? Do I just sort of pull them out of the air the way that I just did then with my in-depth analysis? No, of the COVID problem, or do I do some other magic? I've been playing in the finance world now for, oh my goodness, since the 1980s. And at first I was green, bright-eyed and bushy-tailed, and I used to think, oh, there must be some really smart person out there who can put these percentages up. 30 or 40 years later, I'm a wizened old academic, and I don't think there is. I think at the end of the day, people just, guess. And that's something for you to think about. Am I right? Are the textbooks right? Or what have you? Who knows where these numbers come from? I reckon that if you're interested about this kind of thing, you ought to really ask that question very, very seriously. Okay, let's get back to the maths. Okay, hang on. Because my estimate of the future is, either recession, status quo, or boom, three different probabilities. And I might say my business, my investment might perform at a particular rate of return in a recession, a particular rate of return in status quo, and a particular rate of return in gangbusters boom. I end up with this. It's actually a very simple equation. It's called weighted mean, and it's a way of using the riskiness quantified in terms of the probabilities of particular outcomes and the returns of those particular outcomes to work out what I really expect here. Some of you might see some lights coming on in your little brain box, and you'll be saying, oh, I remember doing that when I was doing statistics in year 10. And yep, that's what it is. Nothing more than about year 10 maths. It might only be year 9 maths. Here's our example just put into a nice little table here. I am saying I'm going to start to build a Excel spreadsheet here. I'm going to format all of these things into percentages, because that's what I'm interested in. And I'll put a couple of decimal points into my percentages. Now it should be easy to just write this up very quickly. Now I'm not going to put a lot of bells and whistles on this. I just want to go through the engine room, the numbers, and so excuse me while I do this fairly briefly. I'm going to say 3 possible returns, 10%, 20%, and 25% for recession, situation normal, and boom. And the probabilities of those things happening in this case is 25, 50, and 25. So that sort of exhausts all possibilities. How do I do that? Where these numbers come from? That is a question which I think you shouldn't completely accept, this theory until you're confident with that. Also, how do I get these results? We might get a bit of an opportunity to have a look at that. What we're going to do is do a weighted mean. To do a weighted mean, we're simply going to multiply the return by the risk, and do that for all 3 of them. I'm then going to sum these things. I'm going to just use the sigma key here, nice little auto sum, and that gives you that. And what that says is that in this particular case, even though I've got these different returns worked out with different probabilities, what I've done is multiply the return by the probability, da-de-da, and I do that for all 3 options, and then I sum results, and that gives me 18.75%. Okay, 18.75%. Weighted mean. Check that with an Excel spreadsheet. Check it with your financial calculator. Make sure you're happy with it. That's probably about 80% of the maths that you really need to understand for this week. However, we're going to be using this weighted mean to deal with a couple of completely different questions. Okay, so here's expected return. Okay, and we find that that's quantified in the slide. And isn't that lovely? The PowerPoints give us 18.75. That's what we worked out by Excel. So we're right. Make sure that you check this yourself with your own calculator and your own Excel spreadsheet. Okay, it gets a bit trickier. I am cautioning people to say, ask the question where these numbers come from. Because there's no point in just pulling them out of thin air or somewhere even less desirable. And then we move on to even more analysis. We're going to look at the idea of what spread looks like. We're going to go back to an idea that you would have encountered, I would expect, either in your statistics studies somewhere, either at school or in one of the former units in your course here at university. And we get to standard deviation. Standard deviation is a common measure of the spread of likely outcomes. Here we've got a spread of outcomes between 10 and 25% for the returns. Okay, so returns. The spread that we're looking at, I'll just put up 3 other returns here. Okay, what happens if the returns, instead of being 10 or whatever, were in fact 17.5, 18.5, and 19.5. Oh dear, I didn't really want to do it like that. I wanted to put it into different cells. Okay, 18.5, 19.5. Okay. The mean there is 18.5, which, okay, is a little bit different to what we've got. Look at the spread there. Here's a spread between 10 and 25%. Here is a spread between 17.5 and 18%. Now, there's only a 2% spread, if you like, in those numbers, where there is a 15% spread here. I think if these were my estimates of likely returns, then I'd probably be more confident that 18.5 is likely to be the number where it comes in. Here, my spread is very wide of returns, and therefore the 18.75, yeah, actually just lies between the 20, well, it just lies in there, doesn't it? Very wide return. Can I be as confident with this wider spread of adopting the expected range? No. Why? Because it's got this wider spread. What's the measure of spread? This is where we use the notion of standard deviation and its kid brother variance. These are both measures of spread of a distribution of samples. And we need to look at how that's worked. And the best way of looking at that is to look at an example. And this is where slide 22 comes in. And here we've got another example. Okay, we've got investment A, and we're looking at historical returns, and we've got a sort of 2, 5, 4, 7, 7. So it's a spread between 2% and 7%. That's a spread of 5%. We look at investment B. We've got 1%, 10, 1, 11, 2. And so here the spread is between 1 and 11. So it's a 10% spread. So here's a 5% spread. Here's a 10% spread. Obviously, investment B is a bit wilder. It's not as tame. It's not as regular and predictable. And in the slide here, it goes through a little bit of an analysis of that. The notion of standard deviation, though, is got to do with getting a handle, a measure of the fluctuation. The spread is what I'm calling. Here in these slides, we just basically illustrate that and get us to think about it from a few different directions. Investment A, blue, investment B, over period. So it looks like investment B is kind of all over the place. Some years it goes gangbusters, other years it's a bit of a dog, and so on, whereas investment A is doing something else. Standard deviation, the calculation from it is this fancy looking equation here. What that really means is, well, hang on. The equation here we're introducing is actually the variance. Well, I better talk about variance because variance is actually, as I say, like the kid brother to standard deviation. It's actually the quantity that you need to calculate on your way to working out standard deviation. The variance is a measure also of spread, and you get the variance by looking at the probability of an event multiplied by its deviation from the mean, which is the return of a particular event, year often, from the expected return, which is what we're looking at a few slides back, and we square that difference from the mean, square it, and we multiply each one of those deviations from the mean squared. We multiply it by the respective probability, and the sum of those gives us our variance. The standard deviation is the square root of the variance. Okay, we've got to work out the variance first. Let's go through a couple of slides. Okay, last point here, which is what I just mentioned. The square root of the variance is the standard deviation. Both variance and standard deviation are measures of spread, fluctuation, if you like. Let's look at a practical example. Here we're going to use an example which is going to have pretty much the same numbers, which is kind of a little tiny bit boring, but, you know, there you go. Here I'm going to say that I've got returns. In fact, I can use return. Here's the probability. P. Da-de-da. I'll take that out. We don't need it anymore. Expected return is in there. Okay. What I'm going to do is, using these numbers, I'm going to evaluate, come on, this equation. I'm going to evaluate first of all what's inside the square brackets, which is the return minus the expected value for each value of I. Here, I'll use I over here as the element number, whatever. and we've got 3 elements. What we're going to do here to work out the variance, we've worked out the expected value. Now we're going to work out the variance. The variance, I'm going to write an equation. The equation is the difference between the return for a given year minus the expected return. I'm going to make that absolute in Excel by putting the dollar signs in front of the columns and rows. Close brackets. I'm going to square that, and I'm going to multiply it by the probability. Gives me 0.19. I'm going to do that for the 3 instances. I'm going to sum those. I'll just move the sum across here, 0.30, and then I'm going to take the square root of that. And that gives me 5.45. Excuse me, going full screen backwards and forwards here. The green background there, and I'll make it bold so it makes it obvious. And this is the standard deviation. And you can unpack what I've done there with Excel and compare it to what's happening on the slides if you like. Okay, what have we done there? We've basically worked out the expected return, which we did a little while back, which is the 18.75%, and we've then worked out the variance. Then we've worked out the variance from the expected value and so on by basically evaluating the slide, and that gives us the standard deviation, 5.45%. Okay, that's standard deviation, and that's quite elegant. If we know what the probabilities are and if we know what the returns are going to be, let's assume though that we can do that, and so this kind of takes us about as far into the question as we need. However, always important to just remember that there are limits. Okay, generally we assume that we can work out these probabilities and these returns. Okay, what have we done there? What we've done is computed a way of getting an idea from history, if you like. Let me just make that a bit bigger so it might be a bit easier if you're reading this on the YouTube. That if we're not sure of the returns, the possible returns we've got their probabilities, we're able to first of all derive an expected return, and we're able to determine a measure of how much spread, how much fluctuation is likely to come into them. So that's kind of useful mathematics. So working out expected value and also the standard deviation is important. The standard deviation is a measure of spread. Those two values are important parameters. Okay, now we're going to look at applying that same sort of approach, though, not to question of investment in a particular single investment and trying to work out what it's going to do to the future, given what it's done in the past. Here we're looking at history to make that call on what it's likely to do in the future. We're seeing the past 3 years has got this spread of returns, and because we're assigning these probabilities, we're able to say, well, next year is probably going to be about 18.75% return, but we know that there could be about 5.5% variation. So if it went down to 12 or 13%, that wouldn't surprise us, or if it went up to about 23, 24%, that also wouldn't surprise us either, because it's within one standard deviation of the mean. And if you go back to your statistics text, you'll be able to find where they explain the probabilities of various distances from the mean, various standard deviations from the mean. That's not really our topic today. However, if this number, instead of being 5.545, was only 1.5 or something, then we'd be a lot more confident that 18.75 is going to be the number. Here we're looking at one investment. A similar question, a similar analysis will come if we, instead of looking at trying to guess one investment, we're actually looking at a situation where we have more than one investment that we're looking at, where we have a portfolio of investments. Let's just work through the slides though, and we'll show you how that comes in as well. Okay, obvious. Annual returns have been higher for riskier securities. There you go. It actually is a bit of a self-fulfilling prophecy, because it is said that riskier returns have higher returns. Sorry, riskier investments have higher returns. But on the other hand, you can also sort of actually almost reverse engineer that. You really want a low-risk investment that has a high return, don't you? Because that's what makes you wealthier. But in general, you can say, well, at first sight, if someone comes along and offers you 30% return per annum on your income, you say, well, that must be a risky investment. Whereas if they come along and say, well, I think this is a really good investment, it's going to return 2% to you per annum, and say, oh, that's not very attractive. But on the other hand, you should have the comfort of thinking, well, at least I'm going to get my 2%, even though it's not very attractive. And that's pretty much the spread that we do have. The development industry, for instance, often operates on rates of return around 25 to the low 30%, 31, 32, maybe up to 35 perhaps percent in the property development industry, not uncommon, especially for bigger projects. And government bonds, on the other hand, are down around very, very low numbers at present. And COVID is probably not going to help the government bond rate at all. So you're down around numbers less than 5. Okay. Let's look, though, at another way of dealing with this. If I know that I've got risk into the future, I might say, well, how do I deal with risk? How do I manage my risk, given the fact that I don't know what the future is going to be? I've done all this fancy mathematics on the prospects of buying a BHP share. What happens if I buy, I don't know, bet in the TAB or buy my government bonds? I mean, what's going to give me the best result? At this point, we start thinking about a completely different strategy for investment. And here we're talking about diversification. Diversification is where instead of, if I've got $1 million to invest, buying $1 million, I don't know, bit of real estate or $1 million worth of BHP shares or government bonds, I might use a couple of $100,000 to buy some government bonds. I might spend maybe $500,000 getting BHP shares, and I might put the remaining $400,000 into a leveraged property investment. By leveraged, I mean borrowing money to buy the rest of it. So I might get I've got $400,000 to invest. I might borrow the major percentage of it, so I still might get a $1.5 million investment property or something. Okay, so what have I got? I've got some government bonds, I've got some equities, some shares in BHP, and I've got a bit of property, 3 different investments. And I say, well, that's kind of good. I feel safe now, because if government bonds aren't very attractive, at least they're secure. The property investment might make me a bag of money. But if property doesn't go so well, then hopefully the equities, my BHP shares, might make up for it. So I get a little package, a mixed bag of investments. I don't put all of my eggs in one basket. I often refer to this as having a portfolio of investments, and the strategy overall is called diversification. Okay, that's pretty much what I've explained here. 2 or more assets, and hopefully whose investment performance, their cash flow patterns, don't necessarily respond to the same risks and so on. And portfolio investment is a very important concept. Okay, I'll get you to read through these slides. A fair bit of the theory here is what I've just sort of talked you through, but you can also go through a worked example. Okay, what are we going to do here? When we get to working out what the return of my portfolio here is, my expected return is a balancing trick or a weighted mean, exactly the same mathematics, weighted mean of the proportions of the different investments, sort of weighting a mean of their expected returns. If you're shrewd here, you'll notice that in fact we're using the same mathematics. We're only doing a weighted mean, but here instead of looking at the probabilities of a single investment and getting a weighted mean of what we think that single investment is going to return, we've got the expected return of the portfolio, the mix of investments, and I'm doing a weighted mean by looking at the proportions of the component investments. Okay, you can go through the examples there, and I would like you to do the same sort of thing. And here is the worked example. We can model that. I'll just do this. I don't want to spend too much time on this because I know we're a bit short on time in this video. Let's look at the three investments. We've got, I'll put this across the side. We've got the proportions. We've got the returns. We will tell the percentages, and we've got the proportions are going to be 25%, 50%, and 25%. So that's my shares in my different investments. And I'm going to say my low risk investments are going to be returning 10%. My my middle investment's going to return 20. I've got some high risk investments. This might be in a development sort of project or something, and then I might have some low risk investment, which might be, say, a debenture, which I would say is only going to be expecting to return me about 5%. These numbers certainly don't relate to the present market, and I'll do basically an expected value here. Do exactly the same maths. So I multiply the return by the proportion in my portfolio, and I do that for each one of the investments, and I simply sum those, and that gives me this expected result of 13.75%. And so, good idea. Again, practice it with your financial calculator. Best way to learn. Run up a Excel spreadsheet the way that I have just there, but this is a portfolio. Okay, I said at the beginning of our class that weighted means is going to be a major part of what we do. Okay, so that sort of takes us through the example. Okay, then we've got a few tricky things. Now, I'm not going to go through too much of the maths with this, but I want to get to a point, a concept. When I have portfolios with more than one asset, each one of those assets, asset 1, asset 2, asset 3, in my portfolio, each one of these will have a standard deviation because they're going to be risky in their own way, and they're going to have, like the 5.54 that I had up here, each one of them is going to have a uncertainty, a measure of fluctuation of risk. And if I use standard deviation or variance, I could put that in. So I might have those things calculated for each one of these components. What does that mean? It means when I put together my portfolio, not only do I have an expected return, I have also a standard deviation. Okay, and the standard deviation is worked out according to the next few slides. I'll let you work through these, and you'll find that that works out the expected value. Down to that. Now we're looking at working out the variance, the sigma squared. Sigma squared here is the symbol Greek letter sigma with a squared on it, symbol that we use in statistics for variance. And we can also work out the standard deviation for that by taking the square root of the result. Now, the point that I want to get you to focus on is not so much that sort of side of things, and you'll notice that the maths there is fairly straightforward. The important thing is this other measure, covariance. This is a killer, really, really important. And the maths gets pretty tricky, but we don't have to actually do the maths in this unit. We just simply have to be aware of generally how it works. Covariance is the way that even though I might be spreading my risks by investing in a bit of real estate, a bit of shares on the stock market, and a bit of government debt, the fact that I've got a portfolio doesn't mean that I get rid of my risk. And the reason for that is that the government bond rate is going to vary to a certain extent, more or less, I won't say in harmony with, but sort of correlated with to some extent, the way that the performance of BHP works, because BHP operates in Australia, and the Australian government is kind of dependent on companies like BHP for its performance, and vice versa. BHP is to a certain extent dependent on the robustness of the Australian economy, and therefore BHP is dependent on the government bond rate, and the government bond rate is dependent on PhD. And what was the third one we're talking about? Property investment. Property is also kind of correlated. It's sort of connected. And so your diversification through a portfolio doesn't necessarily get rid of all of your risk because of this covariance effect. And this covariance effect is really a very difficult thing to work out. In theory, some textbooks will go into a lot of detail as to how to work out your covariances. And here we've got a nice little equation here. I'm not going to ask you to evaluate this equation simply because I think it's a bit silly. And the reason it's silly is that even though it is very useful and elegant mathematically and perhaps statistically, it's almost totally impossible to evaluate it. And the reason is that these sigmas are, well, first of all, your probabilities are extremely difficult to work out. You derive from your probabilities your expected values and your standard deviations. So you're taking very, very rubbery data, you're putting it through a whole lot of mathematical analysis, and you're ending up with a result which is rubberiness sort of squared, multiplied, and put on steroids. And then on top of getting those standard deviations, you're then going to put that into a third set of mathematics, which is to work out your covariances. And if your standard deviations for any individual assets are a bit sort of rubbery and make-believe, then your covariances, even though they're elegant conceptually, are in practice pretty close to totally unknowable. And I say that from the experience of doing this both as an academic but also as a property consultant over a period of decades. However, we still have to learn it because maybe one day somebody might solve this puzzle in practice. I almost guarantee that none of you will be using this kind of mathematics in professional practice. Okay, however, it's still elegant theory, and so we still cover it. Yep. Okay, so we worked through the maths here. It's a good idea for you to at least read through this. Covariance, we talk about the correlation coefficient. And the correlation coefficient is, if you like, the mathematical derivation of the covariance. Look at the maths. It's kind of has a certain elegance to it. I want to move down, though. You can work through the maths in your own time. There's a nice worked example there. That's good. If we knew what the numbers were, we had the data, then we'd be able to solve that. But I want to move down to an aspect of theory. This down around this diagram here is probably about the best way of looking at it. Okay. As you increase your portfolio, as you diversify your investments, what you do is you progressively, notionally, reduce your uncertainty, your risk. Your standard deviation will tighten up, it will straighten out. But regardless of how many investments you put into your portfolio, what you find is that past a point, the reduction in uncertainty in standard deviation doesn't get that much less. And the reason for that is that you can split risk into two parts, and we call those systematic risk and unsystematic risk. And in this diagram, this brown area underneath is the systematic risk, which is basically risk which is right across the system. And it's a risk that you can't take out because it's simply in the system. Nobody knows the future. And one way or another, you're going to have this error in the system, this risk in the system. However, on top of that, you've got the non-systematic risk, which is the risk associated with individual investments outside of the range of the systematic risk. Through diversification, you're able to minimize that. You never completely remove it. The more investments that you put into your portfolio, the further along this line goes and the closer you get to minimizing your unsystematic risk. That's a useful concept to use. What it means is that probably having 2 investments or 3 investments or maybe 4 or 5, that's kind of pretty useful. But once you get past 5 or 6, you see the reduction in risk by further diversification to your portfolio really doesn't sort of add a great deal of certainty to the result. It's a useful idea to be familiar with what these concepts mean. And so this is where we've got a couple of slides talking about systematic risk. Personally, I have certain practical reservations about whether standard deviation or in fact variance, either of those or both of them, is in fact a good measure of total risk. This is an issue we don't have time to discuss in class, but I'll just leave it to you, especially those of you who have got an inquiring mind, to ask that question. In the literature, in the financial theory, we always use standard deviation, especially of historical returns, as an index of risk, either standard deviation or variance. There are reasons why we use variance, which we'll be perhaps able to look at a little bit further later on. But whether standard deviation of historical returns is in fact a valid measure of risk into the future is an interesting, almost philosophical point. It's not a point that you should ignore because it's in fact extremely important, because it's the very fundamental of all of this theory. And if the future isn't going to be like the past, then basically the contents of these slides is, not necessarily close to the real world. Okay, I'll let you read through that. Okay, we've come a long way this afternoon with looking at this notion of risk. We've introduced in the idea of the attractiveness of diversification through portfolio investing. And the last thing I want to spend a little bit of time on is looking at the question of beta. Now, beta, this is only really preempting what we're going to be doing in week 5, where we look at the capital asset pricing model in detail. Capital asset pricing model, CAPM, it is a relatively simple piece of mathematics. It's sort of useful conceptually. There's a fair bit of discussion as to how valid it is in fine detail, and we'll leave that for the moment. But the idea of beta is interesting. The idea of beta is that beta is the fluctuation or the level of fluctuation of a particular investment compared to a risk-free investment. And so the higher the fluctuation compared to a risk-free investment you have, the higher the beta. And that's basically telling you how the capital asset pricing model works. And you can just read through the notes here. Important for you to read through the notes. If I just recite it to you, I'm not going to be sort of telling you a great deal, but read through them. There's a worked example here. You will notice that the example here in slide 63, and by all means do this in your own time, using a calculator in your Excel spreadsheet to actually get the same answer. Make sure you get 1.42 as your answer. But if you look at the maths here, even though it's for a different particular circumstance, the maths is simply a weighted mean. And as I said at the outset, all of the maths, or at least a great deal of the maths which is relevant in this particular class, even though we're applying it to completely different circumstances, is nothing more than applying weighted means to different circumstances, different perspectives. And so we work out the beta of your portfolio as simply the weighted means of the betas of the individual assets. I don't think that necessarily will be a very satisfying thing to learn at this moment, because you really need the capital asset pricing model to totally understand it. Okay, if we're working out the beta using a weighted mean, it turns out that you use the same thing, the weighted mean, the mathematics of weighted mean, to work out the expected value of the returns. We've done that before, and so you're able to work through the worked example there. Okay, and the solution is there. Okay, just worked examples. And that leads us down to slide 69 and 70, which gives us two equations, or 2 pages of equations, of what we've covered today. I said at the outset, the concepts here are probably more important than the maths. Most of the maths is weighted means. The things that aren't weighted means, we will not be examining in great detail. We may be asking you for them in assessments. However, if we do, you won't have to memorize them. It's just a matter of applying them. So be prepared to maybe look them up from the notes or from the textbook and apply them if you're asked. But you don't really need to commit them, by rote to memory, unless you think that being able to spew out an equation like sigma squared R2 asset portfolio equals da-di-da-di-da-di-da-di-da-di-da. Maybe that might impress friends when you're trying to increase the size of your network at some party or something. Okay, so look at those equations. Really make sure that you've read through the notes. Make sure that you've done some of the worked examples. Certainly do at least the maths here, whether you do it on a spreadsheet or whether you do it on your financial calculator is up to you totally. By doing the maths, it really helps you to understand it. Okay, in the class, I have done a pretty savage job of saying this stuff has got a lot of mathematical elegance, but you're not going to use it in the real world. That may be true, may not be true. I might be just pulling your leg, or I might know what I'm talking about. Regardless, I want you to be familiar with doing the maths. And that means that I want you to actually sort of do this stuff so you're mathematically competent. And so when it comes to you making the decision of whether I am pulling your leg or not, you're comfortable with the maths, and so you can then make an informed decision and a good conclusion, if you like, from whether Small's right or whether the textbook's right or whether Dr. Imam is right or whatever, because that's really going to determine how you go into the future, and especially how your future career goes if anyone asks you at some point to use some of this material. Okay, thank you very much for your attention. This is not the end of the road as far as this topic goes. I still make sure that you've read the chapter, gone through the slides, read the parts that I've said to read that I haven't read, and so on. And whatever you do, make sure that you do the maths to actually sort of check it yourself. Write it up on a piece of paper or something, or on the computer, whatever's comfortable with you. It's really important that you get your mathematics skills stronger by checking this stuff. Even if I am right and you're not likely to use it in practice, at least it will give you the mathematical smarts to be able to make an informed and wise and educated decision about it when somebody says, why is it you don't bother doing that? And you say, oh, well, back in 2020, Dr. Small said that this was an awful lot of baloney, but I've got to understand it anyway. I took him seriously. Okay, I might be talking baloney, but that's for you to work out and make a decision about. Thank you very much for your attention, and hopefully the classes will operate properly into the future.